Well, hello everybody. Today we're going to be talking about Twitter and their financial statements. We're going to look a bit. We're going to look at the sales history of the company. We'll look at the stock price performance, and then we'll focus on retained earnings and their deferred tax asset accounting. In the end, we'll talk about other assets, a topic for future, and we'll talk about the stock valuation. So, I get most of my information from the website of the Securities and Exchange Commission. On the top right, company filings. On the next page, TWTR. Click and search for Twitter. I also get my information from the Investor Relations page, and you have the URL up there, or you can do a Google search. Now, recent financial releases, they release their results, and that includes an earnings highlights page, and they talk about the good and the bad, and they spend more time talking about the good, and that's not surprising. So, the main fact over here, average daily active users, 186 million, for them, a key metric. Let's have a look at a sales graph. So, going back to 2011, I have billions of dollars on the y-axis, I have time on the x-axis, and we can see the trend in sales. This is the consensus forecast for 2020. Compound growth, 32.5% from 2012 onwards. That is very good. The largest markets are the United States, followed by Japan, and then there's a sharp fall-off for all the rest of the world. Now, a little bit of the stock price history. They go public on November 7th, 2013, $26 per share. At the end of 2013, there were a number of days and a number of trades above $70 per share, and you can see the stock price pattern since then, closing today at $39 per share. Now, let's have a look at this retained earnings. At the beginning of 2011, beginning balance minus 105 million. At the end of 2019, retained earnings, call it 12 million. To go from the minus number to the plus number was an increase of 117 million. But there's a dividend tucked away over there. So if we exclude the dividend, their retained earnings went up by 153 million. If we go back to that sales graph, they sold for 19.4 billion over these past few years. You would expect them to make some profit, but indeed this is not the case. Let's have a closer look. Just remember this, the increase in the retained earnings, 153 billion from 2011 to 2019. So, I go to all the annual financial statements. I get the income from operations. Combined loss, 1,337 and a fraction million. Interest expense, 618 million. It's on top of this. Other income, it's a small number. Investment income is a positive number, so it is an addition. And if I add this up, the losses from operations, the total interest expense over the period, the total other income, and I add the investment income, I get a loss of $1,690 million. But just watch. The increase in retained earnings was 153 million. How can you lose 1,690 and show an increase in retained earnings of 153 million? Well, this is my book. I had to put on my accounting sleuth cap, and I had to take an even closer look. So again, the increase is 153 million. If I add all those components, they lost 1,690 million. What should happen is that this balance should have gone down by that amount. Now, I don't expect fraud here. I'm simply saying in my book, I have a chapter on financial statement fraud? Here is the answer. If we go to the income tax expense, this is normally an expense. People pay tax. You don't get tax back. And I add all the income tax up. I'm adding all these numbers. They have a positive number from income tax of 1,844 million. In other words, they have income from income tax of 1,844 million. And when I net this off against, remember that number, I get a gain of 154 million. But remember that the increase was 153 million. And I don't expect you to even look at this. I'm simply pointing out that there are other small adjustments that affect retained earnings that do not have to do with the actual profits for the year. And that accounts for the difference between these two numbers. So, from operations, paying interest, getting interest, and the other income, they lost 1,690 million. They made, this is surprising, from income tax, they gain 1,844 million. That's why their retained earnings went up to, I think the number was 12 million. Here's the answer. Remember they gained from income tax? On the balance sheet, at the end of 2019, they have a deferred tax asset, 1,908 million. What is this? And they tell you that they have it. They tell you that they created it over the period 2018 and 2019, and they give you the numbers over there. This is almost like my local grocer that has a fuel points program. And if you buy groceries in September, you will get a discount on your fuel in October. And in essence, what this asset is, it means that in the future, we are going to get a discount on our income tax to the tune of 1,908 million. Now, I enjoy the program, and at the end of September I will have points, and at the end of September I will be entitled to a discount in October, but I don't put that on the Martin & Greeny balance sheet saying asset, discount that I will get in the future if indeed I buy fuel at Kroger. Here we go. Let's do a little closer look again. Here is the deferred tax asset, 1,908 million. This was the retained earnings, about 12 million. If I subtract out this deferred tax asset, they have lost from trading, from operations, interest, the other income, and the interest income, they have lost $1,896 million and a half. Is this so terrible? Well, we'll have a closer look and do one more calculation. I'm going to take this loss at the end of 2019, and I'm going to divide it by the daily active users, but I'm the current daily active users number, and this tells me that they have lost $10.20 for each daily active user. Is this so bad? You know, maybe not. Maybe these daily active users will start generating a profit sometime soon, and they will get paid back their $10.20 and more. Now, they're not hiding it. In the audit report, the auditors have two critical matters. One of them was the valuation of the deferred tax asset. They talk about the company recognized the deferred tax benefit for the year ended December 31st, 2019, and they talk about what they did in connection with that deferred tax asset. So, this is the deferred tax asset in the financial statements. This is extremely complicated. I'm thinking this is one person working for a year to get all these numbers right and to actually be able to report these numbers. So, now let's have a look at the 6 months to June 30, 2020. Watch what happens. Revenue went down. Remember they said it went down. This is the 6 months. They make a loss from operations. They make an even bigger loss before income taxes, and now they have a tax expense of $1,081 million, making the total loss, you can see the loss has become even bigger now, of $1.386 billion. Suddenly, they have a huge tax expense. Indeed, this tax expense is about 350% of the loss. When you make a loss, you don't pay income tax, let alone paying income tax of 350% of the loss. So, something has happened. Let's have a closer look. Just remember, this is June 30th, 2020. They talk about their financial results. They talk about the decline in advertising revenue. And here, we need to actually talk English again. What they're saying is, remember that deferred tax asset? We decided to write it down by 1.1 billion. When they write it down, it's an expense here. They decided to write it down by 1.1 billion, and indeed, now their loss is even bigger. So, we'll get back to it in a moment. This is their balance sheet, and this is what we'll talk about next time, because these talks are just too much fun not to do again. We're going to be looking at the balance sheet, and we're asking, why do they need so much cash? We will also look at the accounts receivable and say, if I compare the accounts receivable to the sales for the quarter, this tells me that I have 80 days of sales outstanding. And we'll at least ask the question, why does it take 80 days for your customers to pay you? We'll talk about goodwill. And indeed, if we go back and just have a look at this latest one here, loss. When you're making losses, you actually don't have goodwill, and what might happen is that this goodwill might be written down, and they get written down in the income statement. This is what they have left. Deferred tax assets, they still have 800 million left. There's a problem. This might get written down again, so we have another 800 million to go. So, again, we're making losses, puts the goodwill in danger. We'll come back to these assets next time. Here we go. This is June 30th. Suddenly, now, we have a negative balance on retained earnings, but remember, we still have that deferred tax asset of 786 million. If this gets written down, that accumulated deficit will be going up. A bit of theory, if you're interested, you can look at Google this, Conceptual Framework. It's free because it's still a draft. The usefulness of financial information is enhanced if it is comparable. And I'm sorry, Twitter, but when you write up the asset in 2018 and 2019, and you write it down again in 2020, your financial numbers are not comparable. This means a reduction in usefulness. Financial information has predictive value if it can be used as an input to processes employed to predict future outcomes. When you write it up in 2018 and 2019, then you write it down, that your bottom line really can't be used and has no predictive value. That maybe your daily active users has, but not your income statement. Now, I said we'll talk a little bit about valuation. So we're going to use a couple of facts here. 800 million shares outstanding. A market capitalization of about 30.8 billion. And a price earnings ratio of the competition, 33.33. Just round numbers. That's approximately where Google, Microsoft, and Facebook are. Price earnings ratio of 33.33. Let's do the perfect income statement. Income before income taxes, $1 billion. Tax, nice low rate, 20%. Net income, 800 million. This would be for the year. Shares, remember we said 800 million outstanding? earnings per share, $1. Price earnings ratio, multiply the two. Imputed price per share, 33.33, if all these things are true. Actual price, 39. We're not going to split hairs. Let's just say this income statement will give you that price. Now, income before taxes, $1 billion. This is going to be a stretch. This is 2019. Revenue, income before taxes. To push this up to $1 billion, this number here needs to go somewhere north of $4 billion in revenue. So, their income statement last year looked nothing like this. This year is going to look nothing like this. Why is the stock price here without an income statement that looks like this? Well, I talked to my friend Albert, and he helped me out. Mark, stocks like Facebook and Twitter don't trade based on conventional valuation multiples. They trade based on a growing number of users' subscribers, with the prospect of mining the user database and offering advertisers a more focused and target advertising product. Good point. Caveat: only investors who stuck with them early in the game earn outsized returns. He's right here. Go back and have a look at that stock graph. Unleash the power of Twitter data. Enterprise API platform. And here's a little note. Data licensing and other revenue totaled $121 million, an increase of 6%. What this tells you is they have started to sell, and they are going to start selling the Twitter data. And indeed, they trade based on the prospect of mining the user base. So, however nice this was, it was based on conventional valuation methods. I leave it up to you to say, well, we have to take this, and we have to take this into account, and then we'll get a fair price on Twitter stock. To conclude, this is my website. I have all sorts of interesting things there. Go have a look and enjoy. And if you want to contact me, the contact form is over there. I've enjoyed our little talk. And so from me to you, it's bye-bye.